Bank of England Governor Mervyn King was giving his latest UK inflation report in London today. He said that although the recession had been deeper than first predicted, the quantitative easing was beginning to have a positive impact, and he talked about the latest plan to extend these further with an extra £50 billion injection of new money to boost economic growth.
My far right, Spencer Dale, who's the bank's chief economist. Next to him is Charlie Bean, who...
The world economy remains in a deep recession and its financial system in a fragile condition. But there are more encouraging signs looking ahead. Confidence has recovered somewhat from its collapse last autumn, and strains in financial markets have eased. Around the world, the policy stimulus has been extensive. At home, bank rate has fallen almost to zero. The MPC has announced a programme of asset purchases totalling £175 billion, and further hundreds of billions of pounds have been directed to supporting the banking system. Nevertheless, nominal indicators remain weak, and the adjustment of balance sheets has a long way to run.
Any recovery next year is likely to be fragile.
The recession appears deeper than the MPC thought likely at the time of the May report. But as the impact of destocking has turned round, and the effects of a lower exchange rate and the policy stimulus have begun to come through, the pace of contraction has moderated. It's likely that output stabilised in the middle of this year, and business surveys and other short-run indicators suggest that growth is more likely than not to resume over the next few quarters.
With spending down by 4%, a recovery could be slow. The MPI is taking action to inject money directly into the economy.
The aim is simple: to increase the supply of money and so boost nominal spending in order to meet the 2% inflation target. In turn, that will aid recovery. The ability to conduct asset purchases to boost the supply of money does not depend directly on the banking system's ability to lend. But constraints on the supply of lending will diminish its effectiveness in stimulating a recovery. It will take time for banks to repair their balance sheets, and they face considerable challenges in replacing those sources of funding that dried up in the financial crisis and the temporary support provided by the public sector. Our continuing operations in corporate credit markets are helping to ensure that, for some companies at least, an alternative source of finance is readily available.
The IMF paper is a thoughtful and careful.
And he said inflation is more likely to be below target than above it in the medium term.
Given that outlook for inflation, the Monetary Policy Committee last week voted to maintain bank rate at 0.5% and to increase the programme of asset purchases to £175 billion in total. Those actions were taken and were necessary to keep inflation on track to meet the 2% target in the medium term. The committee is very conscious that at some point this extraordinary degree of policy stimulus will need to be withdrawn. The framework within which bank rate was cut and asset purchases are being carried out, the inflation target, is the same framework within which at some point bank rate will be raised and those same assets sold.
He concluded the stimulus, along with the previous drop in sterling, would lead to a slow recovery in economic activity, but he warned that the timing and strength of the upturn was highly uncertain. In the long run, he said, there needed to be structural change to the banking system so that those institutions that want to engage in risky proprietary trading cannot do so on the back of the taxpayer.